So today I wanted to talk about the Altria group, and despite the interest around it, I think it will massively underperform the market. Even someone such as myself having a large emphasis on cash flow through covered call funds, such as JEPQ, I'm simply staying away from Altria. With a 9% starting yield and 53 years of dividend growth, I think it's fairly obvious why this attracts a lot of dividend focused investors. But I think the story and the whole attitude towards the tobacco industry as a whole, as well as today's trends, paint a very different picture for this company moving forward. I think an undeniable fact around these smokable products is that it's on a significant decline, shown here with the second highlighted paragraph, going from nearly 21% to 11.5% in 16 years. You have the product being marketed primarily towards the people with the least amount of expendable income. And then smokers separated by age group, the smallest amount by a wide margin is the 18 to 24 group, which if Altria wants to move forward, I think they're really going to have to pull from that group. The largest is the 45 to 60. Now, moving forward, Altria has stated that they have a progressive dividend goal for mid-single digit dividend growth, which is up to the discretion of the board. And I bring up that last part specifically because dividends from a company are never guaranteed, and that there's a possibility, however unlikely that possibility may be, that Altria cuts the dividend. A company that a lot of people own strictly for the high yield, being what is considered undervalued and significantly off of its all-time high, and that really had a lot of the same enthusiasm about it, I believe, was Intel. And they had slashed their dividend by over 65% just based on their discretion. And this was shortly after CEO Pat Gelsinger was saying that the dividend was healthy. And after the cut, they then go on saying that the board and I continue to view the dividend as a critical component to the overall attractiveness of Intel, something that seems to eerily ring similar to what's going on with Altria at the given time. This next segment is just showing that Altria had purchased Enjoy as part of their tobacco-free line moving into the vape and nicotine segment. And going into the earnings, the all other category on their earnings for the report that I'm going to review later is where the Enjoy sales are going to be showcased. Now, they also have Helix in this category, which produces the nicotine pouches under the On brand. These are basically a tobacco-free alternative to long cut tobacco or pouch tobacco, moving into the tobacco-free segment. However, the majority of sales that I see from just my own perspective are coming from Zyn, who is owned by Swedish Match. I've actually never seen anyone buy or use On. The only product I've ever seen is Zyn, which just leads me to believe that Zyn has captured the market share that On really would need to succeed moving forward and support the declining tobacco levels that Altria is seeing. Now, the numbers reported here are in millions. So we have smokables being your traditional cigarettes coming in at 5.8 billion, oral tobacco at 680 million. And then we have the all other segment, which we had previously discussed being the Enjoy and Helix brand products. And that has a revenue of only 8 million. And this is where I get very concerned for the future of Altria going forward, is that even a small decline in the amount of traditional tobacco cigarette users is going to have so much more of an impact compared to a large increase in the all other revenue. Is just that when you're talking percentages, a small percentage of 5.8 billion is going to have more impact than a large increase on 8 million. Now, the pods that Enjoy sells are supposed to be roughly equal to one pack of cigarettes. So one pod to one pack of cigarettes. So you have $10 for two pods, which contains 1.9 milliliters of liquid at a 5% nicotine concentration. And then compare this to a competitor with 11 milliliters of liquid at the same percent nicotine concentration for $4 more. And from a consumer perspective, the value is so much incredibly better for the competition here that I don't really see why anyone would go to an Enjoy pod. And considering that the vapes are all flavored, they're all the same USB style product, battery operated, that I don't really see any sort of major production difference between these two. So it's just going to be a nicotine concentration in the amount of liquid that you're getting that's really going to be driving these sales, in my opinion. So these are just some thoughts that I have moving forward. There's a decline in traditional smoking, not from a sales perspective, but from the amount of users. And I question if the loss in users from traditional cigarettes are going to be able to be captured and then resold on the Enjoy products. And that's kind of leads into the second point. Is the increase in vaping going to be able to replace the lost consumer from traditional smoking? Is the dividend worth it if the principal capital is lost? Does it make sense to have $10,000 be turned into $7,500 just to collect $1,000 of dividends along the way? And I believe the best days of the tobacco industry are behind them. And it doesn't really make sense for me to put any capital into a company where the whole attitude is if they can only get back to where they once were, despite all the new regulations, flavors of pods and smoke-free tobacco being banned, the whole attitude, the way they're even allowed to advertise. Before you had things like Joe Camel and the Marlboro Man, which were sort of these iconic characters that were marketed towards everyone, and they were made to make like smoking look cool. And you can't do those things anymore, and it's almost like shunned in a way. So I did some historical comparisons looking back 5 years, as that's my preferred time, as that's when I view that I could have reasonably started investing in these companies. And the most I generally go is 10 years. But you can always back test further, but personally, I don't see the point. So the past 5 years for Altria versus the benchmark S&P 500 is you have negative returns. And even with the dividends reinvested, you have a negative 1.44% compared to a positive 10.3% for the S&P 500, which is a massive underperformance. I mean, you can see the capital is just eroding from Altria, and you're almost doubling your money in 5 years with the S&P. Now, if you go back 10 years, you have a positive return for both Altria and the S&P 500, but you can still see that it's a massive underperformance. I mean, you're missing out on $12,000 of total return with the S&P 500 just to collect some dividends along the way. I don't see any way in which you could justify that sort of underperformance. And then something that I would like to compare it to would be like a company like Costco that's also been around for a significantly long time. However, the fundamentals with Costco continue to improve every year. And you can see you tripled your money putting it into something like Costco over the past 5 years as compared to Altria. Now, Costco is one of my favorite companies, both as an investor and a consumer, but I think a comparison to what I would view as an incredibly high quality company compared to something like Altria, where I'm viewing this as a value trap, is something that is warranted in this situation. So the benefits to Altria that I see, I guess, is a high dividend yield, qualified dividends, and the anchored expectations, I think, is they're generally extremely close to what they say they're going to do. And you're not going to be blown away one way or another with a massive beat or loss on the earnings, in my opinion. But all those things, when you look at them in a total return aspect compared to another high investment, a high income investment such as JEPQ, I don't think that a nearly 20% underperformance is worth any of it. And it just doesn't seem worth the opportunity cost to put any money into this company, and that's why I'm staying away from it.